Howdy, Jacob here. Today we're going over uh, an energy company in Brazil, ticker symbol CIG, and we're seeing a 6.55% dividend yield, $5.6 billion market cap, 6.9 enterprise value. It's an electrical utilities company down in Brazil. They generate and distribute energy down there. So, out of my initial knowledge, as most of their business occurs outside of the United States, but that doesn't mean we can't look at history and come up with what we think from a very high level would be a price point that makes sense to us before we start digging into more of quarterly reports and everything to actually learn more about it. So, initially, price to earnings 5.5 looks incredibly cheap. Earnings have been pretty, our revenue's been pretty wild, 6.2, 7.4 billion down to 5.6, all the way down to 4.9 during COVID, and then back up to 7.1 billion right now. So almost the highest it's been. Well, the highest it's been since 2014. Um, but they've always made profit, so that's always good. Let's see about cash flow. Um, yeah, it made even more free cash flow. Um, so it doesn't. It looks pretty cyclical from a high level standpoint, um, but it's a type of company that if you're looking for a dividend stock, you want to see history, not necessarily just a history of dividends, which is also good, but um, a history of consistent earnings and profit since the distribution of a dividend comes from excess free cash flow. And so here we can see, let's look at the balance sheet because there was a little bit of debt, it looks like. Um, okay, they've gone down in debt as high as 3.7 billion in 2017, cut it almost in half to 1.835. How much is that? Oh god, that's in comparison to its earnings. If they can make over $1 billion, I mean that's really not a lot. Um, let's see, investments have gone down, property and plant have gone down, other intangible assets have gone up. So it looks like their tangible assets have gone down while their intangible assets have gone up. Okay, so I'd want to look at that. It could be they're changing their business from, um, strictly operational to, it says cloud solutions and IT infrastructure management services. Okay, so it could just be a change in um, business goals and such. But yeah, let's start off with some initial assumptions. Okay, so I mean, I'm indifferent. I almost want to say because it's utilities, it's going to go up with inflation, but it also looks cyclical. So I might say, maybe it goes down to, mid 5.5 billion before it goes back up to the 7 billion that it's at within the next 7 years. I mean, I feel like that'd be the most appropriate without doing more digging is to just be more conservative and say, you know what, this is a pretty cyclical business for me when I look at the last decade. Um, and so for that, I might choose 0% revenue growth. And um, I mean, with a no growth company or a cyclical company that's just going up and down with the same numbers, shouldn't really deserve higher than the 10 price to earnings. And then I mean, their earnings and cash flow are greater, but I might just take an average since, so we're looking at 10 and 13, just take an average due to the company being a cyclical company. So at times it's going to have what appears to be an extremely cheap price of, let's say, a 5p, and other times it might look a little bit more expensive having a 20p. But in reality, if you average it out, we should be pretty close to these type of numbers. And then shares, I mean, not seeing really any share buybacks. Okay, so they just shoot dead even on the share change, and with that, we're seeing that with these assumptions, it would need to drop 14% to get to a 15% return. I mean, that's really not bad for a company with, and again, we assumed 0% growth on the dividend side because we're saying that earnings and free cash flow are going to fluctuate with this type of business. And we can see that so if their dividends, 8 cents, 22 cents per share, 6 cents per share, upwards of 26, and now it's 14 cents a share. So I think we can average out to the 14 cents, and that's a pretty fair assumption. But again, 14% to drop before it gets to, again, with these assumptions, 15% return. That's pretty good. So this would be definitely be a company that I'd like to look into a little bit more, and I got to start doing that with some of the other companies. I think we're at 2 or 3 now that are pretty much within 10%, and that's what I want to do, more deep dives on these companies to see if they're um, truly good buys, or whether I look at their quarterly reports and nothing makes sense and I just take it off because um, my initial screening is for companies that make sense through just looking at the numbers. But if I can't understand the business and how they're consistent or not, then it's not a company that I'm able to invest in. I hope I'll teach you guys throughout this that um, the same, that can't invest in something that you don't understand. So thank you so much and have a good rest of the day.